welcome back to Consumer Says. I'm Sophia here with Morning Consult Economic Intelligence and my colleague Deni. Hi Deni, how are you doing?
I'm doing well, Sophia. How are you?
I'm doing great. Excited to get into our topics today, but before we do that, I wanted to remind everyone to sign up for our newsletter, which I put a link in the description as always. So make sure you sign up for that if you want the written piece to go along with this and a lot of the background memos and charts and whatnot. But we do like to put in charts as well in the video, so stay tuned for that. But today, I think the main topic of our discussion is going to be on consumer spending. We will do a brief temperature check on that, but then also get into what's going on under the surface in spending because there's that top line level, but then there's other things that are going on within spending and downside risks like tariffs, which continue to be on the table. We still don't really know what's to come, but some things have already been put into place. So we're going to pick Deni's brain on that because she's been thinking a lot about tariffs, as many of us are. So let's get into it. First things first, we're going to do our temperature check where we ask about something in the economy and relate it to the weather temperature. Deni, could you give us a temperature check on consumer spending in the United States? Where are we at?
I think for this week's temperature check, we're gonna once again put us into around 65. Again, 70 is the sweet spot. And which brings us to it's not that bad. We've had a lot of conversations lately with clients and just also read in the news all the recession talk lately. Keeping that in mind, 65 is a pretty good number, and we can point to several different data sets to come to that 65. Um, I'll start with our own data set, Morning Consult's spending survey. We survey every month US consumers on their expenditures in the previous month. So our latest data is for February. And our data came in pretty strong. It was perhaps stronger than some might have expected, but it sort of shows that while there's all of these threats on the horizon, there's all this conversation about economic uncertainty, risks, and they're very valid. Uh, in February, the US consumers still spent money. Um, and I think we can sort of talk a bit more in the same lens when we look at the government spending, right? Sophia, if you perhaps want to talk about retail sales.
Mm-hmm. All of the different spending measures are slightly different in their own way based on what categories they track, how they do the measurement, who they ask. For example, at Morning Consult, we survey consumers. A lot of these government measures, they ask retailers or businesses. So a trend like pulling back away from retail sales but just all spending is that spending was a bit muted in January. Our spending did increase in January, but it was the lowest January spend that we've seen in several years. So it wasn't that great either. And then we saw negative sales for growth for retail and personal consumption expenditures, which are the two government spending surveys that people closely watch. So that kind of spooked a lot of people who follow econ news, including markets. But February was a bit better. We are getting later this week the PCE numbers, so we still don't know those yet, but it's expected to be in the positive range for retail sales like you asked for. It was not inflation adjusted. It did increase somewhat in February, whereas in January it did decrease. So it was lower than expected, which was a little not great, but overall it wasn't horrible either. Kind of like what you mentioned with that 65 number. We're starting to see a little bit of some cracks forming and some slowing maybe in spending, but spending has just been so strong for the past few years that it kind of makes sense that it's starting to slow down a little bit, but it's not flashing crazy red warning signs either. For retail sales, some of the weaknesses we saw were in clothing and restaurants and things like that. But we'll have to see what we see from PCE this week. But overall, I think February is a little bit better than January for a lot of these measures, including our own. at Morning Consult. But you mentioned something that I kind of wanted to get into before we get a little bit more into the trends of consumer spending, which is this contrast between what people are expecting versus what's happening now. So I wanted to ask you about our consumer health index and the trends we're seeing there, because I think the differences in the consumer health index versus our index of consumer sentiment kind of really sum up the situation right now between vibes and reality. Do you want to get into that?
Absolutely. And I think it will sort of explain a bit more why we put the 65 to that number. Again, a bit of a reminder of the Consumer Health Index. We've constructed its index using two daily measures from Morning Consult surveys. One part of it looks at a portion of the index of consumer sentiment. This portion specifically looks and asks consumers about their personal finances. And we call this the Current Personal Finances Index, one of the sub indices of the ICS, and essentially asks the consumers, how are you feeling financially relative to last year? This index has been performing relatively well compared to especially all the four remaining indices that are in the index of consumer sentiment. It has been rising. It's just this week that we can say it has just stabilized. And that sort of provides that ammunition, I would say, to the consumer health index because it's made out of personal finances, current conditions, and the other part of it is the unemployment index. And if we look at the unemployment index, um, again, it's made up using the daily surveys that we construct, but it parallels the BLS's unemployment rate. Similar to the BLS's unemployment rate, this index is doing pretty well, especially when we look at sort of the historical period. So the fact that there is a low level of joblessness combined with consumers feeling good about their personal finances allow us to think that they were able to spend more in January and February to an extent. Now, there's certainly risks and there's certainly uncertainty that is not part of this index. I would say that perhaps, especially that uncertainty part that's been in people's minds, could have, you know, affected the levels that we have seen. But if you look at what I would say, the fundamentals for this index, their joblessness rate combined with their personal finances points towards healthy spending in January and February.
Mhm. Yeah, I like to think of it as because, as you mentioned, there's those five sub indexes that make up the index of consumer sentiment. Three of those five, which is more than half of them, are based on the future. So it's a little bit weighted towards the future more than the current. Whereas I feel like the consumer health index is more it's more weighted towards now versus the future. So it gives us an idea of where consumers are at today, how they're feeling about their current personal finances. If they're feeling good or better, that's a good thing because the way that people make a lot of their spending decisions is based on how they feel about their finances today and based on their income coming in, which is provided by that unemployment side of the index. And so, yeah, as you mentioned, that's been climbing. We'll put up a little chart here, but that's been climbing through the past few months as mostly we've seen that current personal finances index climbing while the other indexes in the index of consumer sentiment have been going down since inauguration, especially those three future ones. And then we also have seen a little bit of a rebound in our unemployment index. It went up kind of in line with the BLS unemployment rate late last summer, but it started to correct a bit. And so it was kind of that double whammy of, most people are employed, we're at like around full employment. People are feeling better about their personal finances for a variety of reasons. If we look at actual what is going on in people's day-to-day lives, wage growth has slowed down, but it's stronger than inflation and it has been for quite some time now. So and inflation is not at that Fed's target level, but it's quite a bit lower. We do have that egg problem, which we know bothers people, but eggs are only a tiny slice of the consumer budget. I will plug our egg memo, which I don't think we're going to have time to really get into today, but we asked consumers about eggs, and that was a fun survey that we did as well. But yeah, overall, just to sum it up, it seems like people are doing pretty good today, but there are definitely downside risks, so maybe we should get into those. I don't know if this fully counts as a downside risk, but I think there are shades of it. But one thing we've really seen in our data is more and more reliance on high income consumers to prop up that strength in spending. And it hasn't really been just our data at Morning Consult. I'm starting to see this more and more out there in the news from various sources like Moody's. Had that one report where they're showing that the larger slice of the pie, the spending pie, is being consumed by higher income consumers, wealthier consumers. And then we've also heard anecdotes from retailers that largely target low income consumers having a harder time and whatnot. So, do you want to talk through the trends of what's going on with the income cohorts with spending?
Absolutely. Yeah, we like to look at the income, our spending data through the income cohorts specifically for this reason. What we've seen since the pandemic started, especially a year after, perhaps around 2020 to 2023, 2, 3 years after, is how the spending dynamics have changed. When the high income households are going out and spending in 2024 or even now in 2025, they have a lot more weight when we look at the, spending amounts. And this is important. Exactly, on aggregate spending. This is quite important, when we look at, the threats that are on the horizon. If a certain cohort has a larger weight to the total spending, it will make businesses think as to how they are going to address this cohort specifically. So it's been shown in our data over time how higher income households, they do sway that total spending number one way or the other. And it's also been pretty apparent in our data how the middle income cohort has been acting, especially last year, more similar to the lower income cohort. So that dynamic is widening as well. That gap is widening as well.
Yeah, and something that is also, there's many parts to this too. It's not just spending. We've also seen it with personal finances. So we have our survey of household emergency expenses and decision making, which we kind of talked about very, very briefly in our Gen Z episode a few episodes back. But something that's interesting there is just seeing how high income households continue to just see improved household finances and personal finances, and how they address their emergency expenses is one way to measure that. So we're seeing them paying more in cash versus those low income consumers. They're not seeing those improvements as much. Higher income folks are also relying less on debt, which is more important as interest rates continue to stay relatively elevated. They're down about a percentage point from the Fed's measure, but they're still quite elevated compared to where they were at for decades, when we had a very low interest rate environment for many, many years. And then we also have the savings measure. So we're seeing more and more low income consumers kind of flashing red a little bit with their savings measure. So they're saying that a larger share of them are reporting that they actually have less than a month's worth of saving. So what that means is if they lost their income, they would only be able to cover about a month or less of their basic expenses. And so that's kind of there's a lot of discussion right now on what it means to be paycheck to paycheck, but that is one like rather extreme measure that I think you could argue is truly paycheck to paycheck if you couldn't go a month without income to cover your basic expenses. That's not talking about putting money into your 401k or going on vacation. That's basic expenses. And so we see that number climbing for our low income folks, which is a little bit of a warning sign. And it kind of makes sense when we look at our spending data because we see our low income consumers spending less kind of steadily over the past year, and high income consumers continue to really be providing that strength, as you mentioned, which is something that adds risk because retailers or businesses need to cater more and more to these high income consumers and are kind of at the whims of them a little bit more, which is especially risky for discretionary spending because high income consumers right now are spending on discretionary spending. We saw them increase their discretionary spending a lot in February, for example. But that doesn't mean that they will always do that because what's the first thing to go when you get spooked? It's things that you don't really need.
Exactly. And I think going back to that, savings measure that we have here at Morning Consult, it's particularly concerning to me when I think of the broader picture of, these other broader indicators, looking at the delinquency rates climbing up, especially for credit card loans or auto loans, the savings rate falling. These are more aggregate measures. And in my mind, if we have these measures deteriorating, it's highly likely that under the hood, it's really deteriorating faster for the lower income households, which is concerning when we think about potential threats coming up, especially when it comes to inflation again. I mean, we've talked a lot about, jobs and sentiment, but one of the topics that is now once again being talked more about is inflation. And the aspect is that, if continued tariffs are put into place, that will likely increase prices and that would become a detriment to spending, especially, for lower household incomes. There's many studies out there that show that the effects of tariffs will be different for different households. And while we don't do that survey here, we can kind of agree with that looking at our existing spending data set as well. Um,
Yeah,
so
because tariffs drive up the cost of goods, and especially they can, some of the proposed tariffs could increase the cost of essential goods, which make up a larger part of lower income consumers' budgets. So it's just more painful relative um, to the overall budget of all consumers. While we're on the topic of tariffs, that's a great segue. I wanted to ask you. We mentioned tariffs almost every episode now because it's such a big part of the current economic scene. We're trying to decide, or we're trying to figure out what will go into place, what won't go into place. Will it be inflationary? Will it slow down the economy? But all of that is still relatively unknown because things are still being put into place. We have that April 2nd deadline, which apparently a lot of tariffs are supposed to go into place, although there's back and forth on how much will actually go into place on that day. But that all being said, there are tariffs already in place. So, I think that we see the tariffs being implemented and then taken back and then implemented and then taken back. We forget that a lot of them are still in place. Every time they've been taken back, some have been left in place. So, can you walk us through what tariffs have actually been implemented since the start of the year so we can be all on the same page as we go forward and try to get an idea of how they will affect the economy?
sure, there's definitely been a lot of on and off on tariffs. It's very hard to keep tabs on it. That being said, if we look at this broadly, the tariffs on China is really the ones that are mostly in place right now. So the first installment of tariffs on China went into place in on February 4th. That was the 10%. And then on March 4th, we have another 10% put in place for China. The same day, we also had tariffs put in place for Canada and Mexico at 25%, but then some of that has been taken back, especially the categories that would be covered under USMCA. So the free trade agreement between US, Mexico, and Canada. And now we're sort of going back to this April deadline to see if the rest of that 25% will be put in place. So if we look at it compared to the proposals, um, a lot fewer of them in place right now. That being said, we still have, this cumulative 20% additional on China. And then, you know, certain categories seeing higher tariff rates from Canada and Mexico, and 10% on, certain energy and energy related, potash, for example, products. So we also have 25% tariffs on steel and aluminum that went into effect on March 12th. So we have plethora of tariffs in effect right now that's been put in effect between beginning of February up to March 20th or so. So and again, as you mentioned, there's more to come in
Mhm.
April.
Yeah, so it's not that widespread tariffs that everyone's really panicking about that have been put into place, but it's definitely not insignificant. It's, the China one is quite a bit, 20% on nearly all goods. And then the USMCA exception was actually less than I thought it was going to be. So there's still quite a bit of goods which are seeing that 25% to 10% tariff, depending on if it's energy or not. Um, but are we starting to see have you seen any effects yet from those tariffs in our data or data out there? Is it inflationary yet? Is there anything that we can really point to yet?
So some of the good news that came out of the data from the government this month was actually on the CPI and PPI. They came in lower than expected, which was very good news in the middle of all of the tariff discussion and different data sets that are coming out this month. Um, we also took a look at the import price indices, especially by locality. I focused generally on China now that, that country has the longest duration of tariffs in place. What we do see is that some of the import price indices, especially down to category level, do see some increases in prices. And this comes in after months and months of either stable pricing or dropping pricing. So we do therefore see some of the upstream materials coming into the United States with a higher price tag. Um, but we haven't really seen that in the finished products yet, as it takes time for, for that price to move through the stage of processing. So while there's some increased pricing, probably driven by all the demand from pulling forward all the purchases before the tariffs, um, we don't quite see a lot of, you know, price increases at this point yet.
Mhm. At the
It's
consumer level.
at the consumer level, it's very hard to say that tariffs have caused inflation.
Yeah. So
But
it's
we
too
don't
early.
it's quite early. We will be watching, across the different categories, but yes, it's too early to say that at the consumer levels, at the finished good levels, and even in the intermediate products level, um, there's tariff-driven inflation.
Yeah. We are, just so everyone is aware, we are doing more tariff surveys. We're doing one shortly, coming up in early April to get a gauge on the new tariffs and how consumers are reacting. But even that one, I think will be a little early because we're still waiting to see, you know, what tariffs are going to be put into place. And then it also takes time for consumers to actually see that on their end. We're starting to see it a little bit on the producer end, on the import side of things, affecting those prices, but not necessarily consumer prices. And so, aside from consumers who are super savvy when it comes to following these things, they might not fully understand or be aware of how the tariffs will affect their bottom dollar yet. And so, they can't really make decisions based on how they will act or what they'll do. So, it takes a little bit of patience, but I do think a lot of the effects we're going to be seeing in the shorter term will be more on the business side, slowing down business activity, maybe slowing down investment, bringing you said bringing in imports faster before tariffs can be implemented, which can cause some supply chain shortages. And I think before we close out, I do want to plug our supply chain indexes because we've talked about this in past episodes how they've been heating up slightly. Our delivery delays index, which we've been watching, and if you've been following, has been climbing up slowly, slowly, slowly over the past year. And just in February, for the first time in a while, in years, we have seen that go positive, which means that a larger share of consumers are reporting longer wait times for their online deliveries than shorter, and that's the last mile. Do you want to we'll close us off by talking about the last mile of supply chains and why that's important?
Yeah. So for me, it tells an interesting story of how if consumers are noticing some of these shortages, that means that there's already some sort of strain over there in the system. Um, Obviously, some of this spike was around the groceries, especially around eggs, as we've mentioned. But it was also apparent in other categories as well, which tells us that eggs are not really the exception. There is a broader trend of consumers noticing that things are taking longer to reach them. So um, I think it's one of those that I wasn't expecting to see at this point. But it also poses a bigger risk when it comes to pricing if, consumers, the last mile, is noting some of the shortages at this point.
Yeah, I like to think of the last mile as a river, so everything that has been coming down the stream, it catches everything that's upstream, basically. Um, okay, well, thanks, Deni. I think on that note, overall, I would summarize things are okay right now. Consumers are holding on, but there are these risks going forward. Especially tariff and economic policy related, but also kind of how the income dynamic continues to be a little bit strained and divisive between our three income groups that we track. So something to keep our eyes on. Maybe the next time we do a temperature check, we'll move from 65. I know some of you who wash a lot might have noticed that a lot of our measures are at 65 right now. But I think that kind of points to a consistency where, the economy was doing super well for a few years now, and there are signs of slowing, but it's nothing cool, it's nothing cold, so spending is just another one of those.